gold and precious metals friend. It's yours truly, the Market Sniper, giving you a quick heads up. Oh, it's Friday. And of course, next Friday, unemployment number is yet to come. That's right, it'll be live trading day with yours truly and the rest of the team. We'll be talking to you about the unemployment numbers and we'll trade the traditional markets. But before we do all that, it's time to talk about gold. And yes, gold is here. And remember, our primary call, whilst everyone's super bullish, all the news about COMEX being emptied and London and Switzerland all delivered, we stuck to our story. The run of 2,900 will provide a localized high for us and the gold and metal markets. In that environment where everyone was giving you moon shoots and the gold and silver brigade were super bullish, we warned actually that if you have a large outlay, it's not the time to buy. You'll get more ounces in a bit. In fact, we're getting a little bit of sell-off coming down on the gold market. Let's have a look at the charts. Bang. So here we are. We're on the daily. This little cheeky squeezy Japanesey, we call it like that in the transgender pink. There she goes. That was your daily. Hitting you up, gave you a target up top here. This represented around about the 2,903s. This represented a localized high that was confluencing, a potential localized high that was confluencing with a far larger target that was the bull move target that was the other purple line. These two were exceedingly close. Whenever we get a confluence of technical targets, one on the daily and another on the weekly that are giving us the same level, it's time to get out. Why are targets important? Because it means the best part of the run up is there. That means more sideways action and more downside action with the passage of time. So it is not a good entry point. It's a good point to take profits on your leverage where you've been a beneficiary of that, and it started with an upside HVF. We'll go and show you that on the bigger time frame. You've seen it all before with us. And what you can see, in fact, there was another squeezy Japanesey on the lowest time frame, which is a volatility constriction, which came about on the rising wedge. So often when you run targets, everybody is at peak bull. The narratives couldn't have been more bullish for gold over the last 2-3 weeks, surely. And I raised it in previous. When you get to hear it, it's because you're meant to hear it. And that's straight away a problem. They're not your friends. Believe you me, when the gold person's fantasy of all the super surge comes true, and I don't feel it'll be a particularly good time for the dollar and many other things at that time when that occurs. It's unlikely to be presented the way it was presented here. Oh, we need the gold and we're moving the gold. Oh, panic, and we're emptying it. And all this information is being live provided to you by many mainstream media outlets as well. I'm sorry, that's not going to be that moment. It's quite close to being a localized high. And you could see on a Friday, fancy a Friday for a slam down day. Who'd ever seen that one before? Yes, you have it. The rising wedge is being sold. By the way, you're at about 2.9. What was the absolute high? Let's get some numbers for you. This is technical, and it's what we love. We don't listen to what they say, we look at what they do. And technical charts matter because they're pattern-based. The real truth is in the money flows. Do you know how to read it? That's what we specialize in. You're with the macro technical analyst that called the single digit oil price. It called the collapse of the euro Swiss franc prior in 2009 to the pigs, and then the subsequent fail of the 120 peg. Was suggesting you be long during CV19 with a gold versus oil, and is currently in that same gold versus oil trade. What will we be seeing on oil? It's going to be interesting to see because the gold leg is, of course, arresting. So you were as high as 2,956, I see, 0.32956, and you're now trading at a current price, and it is selling off to 830. So you've shed $120. This is the value of targets, by the way. If you'd got out on the run of our targets up top there at around 2,900 to 905, you are better off. You will have not had the cost of that leveraged position, and you will, of course, not have eaten the red move. Yes, at one point you are marginally high, but as we've warned, when you run a confluence of targets are always run through. This is the 100-meter sprint. You never see a sprinter stop with the tape at his chest. You've got to run through it. So targets are typically taken, so there's a small overrun, but you could see the volatility. You had a shooting star and a pullback there. You had another pullback there. It started to get choppy. Then this very low volatility, small bodies. Let's zoom into that a little bit. We should give you a little better view as the technical man that we are. You can see super low vol, not much change between the opens and close, a lot of range trading, then an attempt to go higher, marginally higher high. We talk about the marginally higher high and how dangerous they are when you just do the technical takeout of the other and there's no more follow through and you pull back. That is exhaustive. So what's actually happening is the weak money that are buying the news are all chasing in. Oh, gold's going to move. It could melt up. There we go. London's got rid of all their gold. Da, 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 da. Switzerland's got no gold. Da, 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 da. The excitement, the hopium, all coming up super strong. But in actual fact, you're getting resisted there. You resisted there. A marginally higher high resisted there. A marginally higher high resisted there. A marginally higher. And then you have your falling wedge structure. That's how you take out confluences of targets. You often squeeze through, but you're scraping out the bottom of the barrel. And then the bid's gone. That must be in money that at any cost chases in is not the smart money, and then that bid is gone, and then you start to get your first correction. You come back down to the key levels of significance, which are the two targets. You supported it for a while, and now you wait for Friday special slam day, and you are giving it up, and you're on the downside. Now, I don't know how the session finishes. I'm updating you now. It is 17:57 UTC plus 3 time. That's about 5 o'clock for me on UTC plus 2 time. I just leave it on Cyprus time sometimes, regardless where I am in the world. But that is a very harsh sell-off now, and there is some retracement. In percentage terms, from the high point, what are we looking at? As I've highlighted, gold has a fairly decent downside percentage beta. It doesn't absolutely die. We're talking about 4.14%. It's not what Bitcoin's done from its high, which is a far higher beta. Volatility responds much more aggressively to the downsides. And remember, it's how badly it sells off. It's how strong your asset is at its weakest moment, not how strong it is in its glory when everything's pumping and the liquidity is surging through the system moment. It's not about the absolute number. It's how it performs for you when you need it most. Is it there? How far is it sold off, and how quickly it recovers in the subsequent events. So with that all said, it's an interesting setup that we're facing here on gold. I want to take you back to the second target, the far larger one, and remind you where it came from. So we finished on an upside hunt volatility funnel that gave you that confluencing target on the daily. Where did it all start? There was the other squeeze. Squeezy, squeezy, Japanesey, as he likes to say, sitting on top of the 2K, that dotted line. Key level. Remember we said once, twice, 3 times, 4th time a lady. That is the touch, and reject. The second the lady breaks through. And that's how it works. So you could see since the highs of the events that pertained around the CV19 liquidity experiment, you got the sell-off. You got the sell-off again when you tested it. Beautiful shooting star on that one candle, by the way. That is a intraday, or in this case, week reversal. Down, in a channel back up. And then again, you could see the grinding and the resistance. Marginally higher highs. You were never going to hold that. Then you got a sell-off. But it was a far less radical sell-off that was pointing to the smart money bid coming up on the offer and the bid ladder. There were people ready to absorb if it ever came back down again, and that's why you had a much smaller a dip over here. Then you broke the 2K again, and you set up this upside HVF, and that right there is and was your leverage trade that we said to you we have now closed at the 2,900 level as it was taken. And that's turning out more and more likely to be a localized high of some value. I'm going to take off the draw tool that we have for that particular HVF and just highlight to you the 38.56 entry that went with the stop and placement here and the asymmetric reward you got. That is huge, guys. Many will say, but you're wrong a lot. We are wrong regularly, and we are occasionally right. But when you are winning 38.5 times, you can be wrong 37.5 times for every one time you're right. This is unbelievable asymmetric leverage rewards. And as I've said, it's not even for our investors a time to whale in. If you're dollar cost averaging, for sure do it. But this looks like for now a temporary localized high. It won't be forever. We macro bulls. People mischaracterize us. They think in a binary world. Oh, so you're a bear now. No. On the short term time frame, given given the move that has occurred. We are not immediately short-term bullish. We think you're actually going to pull back, and that's exactly what happened. That's what we said before it happened, just like we gave you this target 2,900 when we were way back here in 2024, 1 year ago, and you just banked for yourself the better part of a 44+% move. Let's do that in percentages just to give you the level. It was roughly there, and you went all the way up to there over the course of 1 year. Oh, I got the magnet on. It wants to suck on to something else. 42.83. You're looking around 43% move if you closed on target. Already down somewhat now. If we just do it to here, it brings it to a 39% move. It's still not bad. Still not too late. By the way, does that mean I'm telling investors to sell their gold? Absolutely not. By the way, I'm also non-advisory. This is me talking about my trading experience, utilizing HVF method, that method that we have formulated over the course of experience for 30 years, trading in the markets, recognizing that the only thing that is a leading indicator, not a lagging indicator, is patterns, volume, and HVF setups. That is it. You too can implement the skill. It's totally transferable skill. It does not require extreme intelligence, intellectual capability. I mean, look at me. Come on, you can do it too. By the way, hit the link, book a call, and you can join our community. Have a lot of fun while doing it, getting better at wealth, managing your resources. Remember, it's about wealth building, capital preservation, and freedom in these reset economic environment times that you are facing right now. Okay, good. So that's gold. That's gold on the big time frame. That's gold on the short time frame. There's a little bit of a risk-offy vibe. We've also seen the 10-year Treasury, so cleaning our face up of all our draws. You've seen that pullback on the rates, so bonds getting a bit of a yield. We mentioned it last time, and in fact, we mentioned it in our Dollar Vigilante pitch pack, that there is an extreme amount of people on the TLT short. Here we go. It's getting close. I'll show you. I'll come back to that chart. Let's show you that TLT crowded short. Once Stanley Druckenmiller and Paul Tudor Jones start talking to their book, everybody wants to play along too. I'll follow the big guys. I'll follow the smart guys. Very stupid, because they weren't the leading indicator. Yes, we were. We told you in August 2020, before it did the 50% dump that it did. We told you up here, over there, roundabout there in August 2020. It wasn't the all-time high, but it was very close to the all-time high. They came online the back end of last year after, remember, after they've got their positions on, they'll talk about their positions because they need your momentum to shore them up even further. So by the time in November, 3 to 4 years now behind us, and then everybody else is following. So we have a record TLT, the long-term Treasury short. You have a record amount that is currently on the short. You know what happens, guys? When everybody runs to the same side of the boat, you need to start thinking about going the other way. And that's why I think there's actually a bit of a wobble in the global economy. There's a little bit of a risk-off vibe, and that brings bid into treasuries. These guys are going to be feeling pain if they entered late. Do not follow the crowd. You must move with your own step. You must make your own decisions. HVF method is the tool for that. Know your stop loss, your entry with a limit or a stop order. Never at markets, because that is an emotional entry. You must know your level you want to be in, and the method determines it. And also know where you want to take off. See the value of 2,900 now that we are falling with that downside momentum. And Treasury is actually getting a bit of a bid. It's also bid up the dollar. Something else I was talking about a lot, by the way. Jobless claims. So you can join us for our live trading day this Friday. Live trading day this Friday with us as the number comes in. I was talking with some amazing people over the last 2 days. Futures for Finance, massive shout out. Had a fabulous time. Thank you to them for looking after me. Saw Matthew Pipenberg and Henrik Zeberg and other interesting personalities in crypto and the gold space. But our point and our key point is the final shoe to drop for a major recession is virtually here. You already have the reversion of the yield curve inversion. This chart in the bottom that I'm showing you, this is actually Bravo Researchers. It's not my draw, but it just showed it really nicely. So I've used their chart and put it in there. All credit to them. That is a low on the yield curve inversion. That was the longest inversion. From when it inverted, we said, not too far off, there's trouble. And then people said, oh, you know, they moaned at us. We had the longest inversion ever. We always warned it only comes on the reversion. And because it was lengthy below and extended below and stayed low for a long time and took quite a while before you broke, everybody going, yeah, look how much of the stock market move you've missed. We always warned it's when it reverts up that you're on borrowed time. We are reverting up. Let's look at what happened every time the yield curve reverted up. You started green line to see unemployment grow. Reverted up, you're seeing the unemployment grow. And also what you'll note with the unemployment grow is the recession bands. And by the way, these are always drawn too narrow. It's a much bigger recession than you think. And by the way, we already had a recession that wasn't a recession. So you've been in a recession, in my opinion. Never mind the fake unemployment stats through the BLS. Never mind the fake inflation stats, which should be more like the shadow stats, and all those good points. Here you go, you have another low, you see the unemployment turn, and you have the recession, and of course the events of CV19, you had an abrupt move. Note how it's leading, it's before. The yield curve went before. That was September 2019, I remember it. We had liquidity issues in the financial markets. Let's have the crisis. Pull the chain, quick. The banks are in trouble. And so we got the major liquidity surge. And of course, the unemployment, the citizens, the man in the streets, you suffer. While the largest was spread, you got given 7 trillion. Many don't know that over 20 trillion was provided to European banks, American banks, all over the world in liquidity. So once again, this was actually a bigger banker bailout in the CV19 events then by number at the aggregate level than it was during the subprime crisis. You didn't know that, you didn't hear that. The numbers just keep getting bigger. So the loans were provided 20 trillion, but it wasn't known for being a banking crisis. Look at that unemployment go. Look at the depth of that recession. It's even wider every time. By the way, if you think CV19 recession was on and off that fast, here I've got a bridge in San Francisco to sell you that's painted orange. But anyway, we were waiting for that green line and we are coming, and that data point is coming Friday, not today. 1 week from today, you can join us live trading day. Me, Francis Hunt, taking you through the crypto markets and the traditional markets. Traditional markets first, as we see the number in. We are benefiting from the oil short. We're benefiting from a cheeky late coffee short. We're benefiting from closing our longs on gold at the 2,900 level. And there's so much more we can talk about that I haven't told you in the traditional markets and also on the crypto side that we have as potential trades and setup, and how you can be protecting yourself if we go into that risk-off vibe. So that's a quick update on gold. It's going to be interesting to see. I would imagine silver doesn't respond particularly well either if it's slam day for gold and silver. Look at that chart. I mean, I haven't reframed it the first time I'm coming to it. Oh boy. I want to show you something on a lower time frame, by the way, which is something we handled with our community that you'd become part of if you were to join us. We pointed out, and you'll see there's a draw on here, and that's been here from when we drew it. There was a bit of a schizophrenic squeeze setup that could be considered an HVF. And we warned with our community, guys, as you go further up the trend, the setups get smaller, the targets get less, and you're scraping out the bottom of the barrel. And eventually one potentially fails. And we had the super low vol here, and we said, great, we've got the bull flag. It's inside our triggering event, the green that's highlighted here by the draw tool, the box. You can only get this tool as a member of our community on the precious metals, by the way. Once you've been with us for a year and you've watched all the content and you're a competent HVF method trader, which comes quickly and is easy, by the way. You started this break and there was a target up there, and we say, we don't expect every pattern to win. In actual fact, we want to, if we are close to the top on our confluence theory, to see the fact that this might actually fail. It either had to be done real quick and exhaust and come back down, or to fail. What happened? We're the only people, by the way, that inside a trading setup have the target, have the entry point, the green line, the stop, the red line. Sometimes we implement that and we could have had it below the flag corner, so we make the risk reward even sweeter, and actually also have the time frame after which you should close the trade if it has not performed inside of the time frame determined by the geometry of the chart. What happened here? You did not make the target that was your high. The time frame was up on that candle. Guess what? You had a failed pattern and you still made money. How about that? Even when it doesn't work, you make money. Why? Because you had a time stop and you got the hell out, which is part and parcel of our trading methodology. You will find out how it is determined. In short, you either have a stop loss exit or you have a take profit exit. But technically, what if the market stayed in between those levels for a very long time? You have a known close the trade. When you have momentum and you're trading a breakout, it should move very promptly in the direction that you expect. The only places we expect a little bit of rest is at our first interim and our second interim. So the first interim in the dots there, our second interim on the dashes, and the full target should be when you rest. What happened? You closed here. What happened next? A last gasp attempt at a rally here. Failure, you crashed down. Where did the support come? On the funnel and at the support. Key levels of significance. If it was a significant level on the way up, it is a significant level on the way down. This kept gold price up. We were noticing it lean. You should have already been closed if you took that extra pattern. I warned the community about that. It's a very small time frame. It's not the same confidence that you would have had on the daily setup and the weekly setup with the bull flag. And once it breaks, it's a potential reversal. What has happened? You came all the way down again, you rested on that stop, then you dipped through here for the first time, came to the round number of 2880s. You are now trading sub 29 and you've had a little bit of a spill to the downside. So localized high call as called, exit by targets at 29 as called, and we are now seeing that come about. So hopefully that little technical lesson on how we operate, and you too can do it for yourself by looking at the technicals of the chart and realize it's time to take off. Most people never get taking profits right. They treat trading as the gain keeps you in the trade and only the pain takes you out. And that's not that is not a process-driven strategy. It is an emotion-driven one. So thanks for watching. And gold currently localized high. Be cautious for now. Yes, macro is a bull. We can't tell you how long you pull back. Stay with your investment. If it's a macro investment that you bought for an extended period, that is not a divestment call. Gold is the right asset to be holding, and in fact, if you're monthly cost averaging, go ahead and keep doing that. You'll get more ounces during this period, but there is a bit of a risk off vibe that is kicking around out there. Till next time, we'll catch you later. It looks like localized high is probably in for gold. We'll see what comes next. We'll see how long we go sideways, down, etc. before the bullishness returns. Catch you later next time. Thanks for watching.
Tired of profit wipeouts and blown accounts from following trade signal groups and other YouTube channels? Looking for a better way to trade, reduce your stress, and minimize your risk? Become a skilled technical analyst and see the charts and markets in a new light using the successfully proven HVF method by Francis Hunt, while being surrounded and supported by a principled, structured, and experienced community. Enjoy a constructive learning environment while practically trading markets, supported by a bespoke platform run through browser and app, specifically designed to teach and engage you whilst learning and growing as the markets move. This is not a Telegram or Slack signal group. All trade ideas are based on a proprietary technical analysis process honed over decades, which is the HVF method, leading to trade ideas with fast-moving breakouts and tight stops, exact entries and exits, nuanced interim considerations, and ultimately, strong rewards. Submissions are graded and scored by Francis for potential high-quality setups, and we provide bespoke tools to help get the job done properly and with precision. Over time and with focused effort, you'll begin to look at charts and price action just like Francis. Community updates every day by Francis and our 3 webinars a week provide a 360-degree approach, which are presented by our experienced team of trade leaders to spot potential trades. We're a community of self-actualized individuals, spanning the globe and active 24/7, 365. The premium community provides a warm, supportive, and cooperative place for people willing to listen, participate, contribute, and to learn. We've changed thousands of traders' lives. Transform your approach to trading now. Transform your life. Book an introductory call with us on the link below.